Active large cap funds have shown a surprising turnaround in the past 2 years. In 2023, about 87% of the active large cap funds outperformed their benchmarks. This year so far, the number stands at 68%. We call it a turnaround because large caps have historically struggled to outperform their benchmarks. If we look at the data for the past decade, only 60% of the schemes have managed to give higher returns than their benchmarks. So what changed in the past 2 years? Why has the performance of large cap funds suddenly turned around? We decided to look at the data to understand. More importantly, we wanted to know if this performance could continue in the future. Hello and welcome to ET Money's YouTube channel. Today we'll analyze portfolios of active large cap funds and discover the reason for their high returns in the recent years. For this, we'll first analyze the market cap allocation of these schemes. Then we'll examine how frequently the fund managers have bought and sold stocks. Finally, we'll look at the stocks that have led to better returns in the large cap funds. Overall, this video will be insightful for mutual fund investors. I recommend watching it to the end. But before we begin, a quick update. You are watching this video on our English YouTube channel. हमारा एक हिंदी चैनल भी है जहां आप ये सारी वीडियोस हिंदी में देख सकते हैं. If you are or you know someone interested in learning the basics of finance, we also have a channel called 5-Minute Finance. I have attached their links in the description section below. So do check them out. Okay. Now let's start by analyzing the market cap allocation of these large cap funds. The reason we looked at the market cap allocation of these funds is simple. We wanted to see if these funds have increased their allocation to mid and small cap stocks. In the last 2 years, mid and small cap segments have outperformed the large cap stocks. It's possible that these funds added mid and small cap stocks to deliver better returns than their benchmarks. In 2023, Nifty Mid Cap generated a return of 44.6%. The small cap index generated returns of 49.09%. Nifty 100 during the same period generated 21.24% returns. That's less than half the returns of mid and small cap stocks. The same trend is visible in 2024 as well. So if these large cap funds had allocated even a tiny portion of their portfolio to mid and small cap stocks, that could have helped them outperform the pure large cap index. It's compulsory for these schemes to invest 80% in large caps. They can invest the remaining 20% in debt or mid and small caps. We examined the data for the last 5 years to understand the change in market cap allocation. By the end of August 2024, their average large cap allocation stood at 84.22%. It was around 84% the previous year too. However, in August 2020, it was more than 88%. Since then, the large cap allocation of these funds has kept on reducing. If they are investing less in large caps, they must have increased allocation elsewhere. So we looked at the small cap allocation of these funds. Now 4 years ago, they had 2.42% allocation to small caps. However, it has gone up in the last 2 years. As of August 2024, the small cap allocation of these funds stood at 5.47%. That's more than double compared to August 2020. We also looked at the allocation to mid caps and debt. There has not been much deviation over the past 4 to 5 years. Clearly, these funds are taking more exposure to small cap stocks by reducing their large cap allocation. The data that we just saw was for an average of the large cap category. This trend is much more prevalent if we look at the fund level data. We came across funds where this shift was as high as 10%. For example, the DSP Top 100 Equity Fund reduced its large cap allocation from 91.23% in August 2020 to 80.39% in August 2024. Similarly, ICICI Blue Chip also reduced its large cap allocation from 91.88% to 81.87%. All this essentially means that based on market trends, the fund managers have adjusted the portfolios to give better returns. We then examine how frequently large cap funds bought and sold stocks in their portfolios. We examined this metric to see if active large cap funds have started to churn their portfolios more frequently. Some investment strategies, such as momentum investing, require frequent stock buying and selling. Through this strategy, fund managers aim to invest in stocks that are currently in momentum. In both 2023 and 2024, momentum investing was a top performing strategy. We wanted to understand if funds in this category are also using momentum investing strategies to deliver higher returns. To evaluate the churn frequency, we looked at the portfolio turnover ratio. This tells us how frequently a fund manager buys and sells stocks. If the ratio is more than 100, it means the fund manager has churned the entire portfolio over the past year. We checked the median portfolio turnover ratio of active large cap funds for the last 10 years. As of August 2024, this ratio stood at 47. In 2023, it was around 45. But how does this compare to the historical trend? So from 2021, the turnover ratio was between 45 and 50. We even looked at the turnover ratio between 2016 and 2020. Surprisingly, the current portfolio turnover ratio was higher during those years. So the change in portfolio churn does not seem to be the reason behind improved performance by large cap funds. Most of them seem to follow a buy and hold strategy. So next, we looked at the trend in the number of stocks held by these funds. If a fund manager holds fewer stocks, it results in a concentrated portfolio. One of the advantages of a concentrated portfolio is a higher upside. Here, the fund manager focuses on few stocks with high conviction. If some of these bets give good returns, it can lead to higher returns at the portfolio level. In contrast, a higher number of stocks leads to a diversified portfolio. The outperformance or underperformance of a few stocks does not impact portfolio returns in a very big way. If large cap funds reduce the number of stocks and the bets worked well, then that could be a factor behind the outperformance of active large cap funds. So we looked at the number of stocks in the category to see if this is true. As of August 2024, the category median number of stocks stood at 52, and as of 2020, it was 41. If we look at the overall trend, the number of stocks has increased. The number of stocks does not appear to be a factor in outperformance of active funds. Most of these active funds have had a diversified portfolio in the past and still continue to have a diversified one. Now, we move to the last parameter that we checked to examine the outperformance. Here we looked at the weight they assigned to stocks in their portfolios. Besides the choice of stock, another crucial metric that can result in outperformance is the weight of stocks. Now, what does it mean? It just means how much allocation a fund manager has done to a few stocks that he or she thinks will outperform. For example, if they think ICICI Bank will give the best returns among banking stocks, they can increase the allocation to ICICI Bank. They may retain other banking stocks in the portfolio, but the allocation will be much lower. If ICICI Bank does well, the overall returns of the fund will be higher than the benchmark. If the bank does not perform as expected, the return of the funds could take a hit. The benchmark for most funds is the Nifty 100 index. So we compared the weight of stocks in funds to their weights in the index. Nifty 100 allocates weights based on company's market cap. However, in active funds, the fund managers decide the weight. The difference in weights can drastically impact the performance. We compared the weights of portfolio of two funds, Axis Blue Chip and DSP Top 100. We chose these two schemes because they had underperformed the benchmark in the past, but their performance has recently turned around. We looked at the top 10 holdings of both the funds at the start of 2024. The top 10 holdings of both funds constitute more than 50% of their portfolio. We then compared the allocation these funds have done to the top 10 stocks to their weights in the index. In the case of Axis Blue Chip, 7 stocks had a higher allocation compared to the Nifty 100 index. The difference in allocation was highest for Avenue Supermart. Axis has 6.09% of its portfolio in the stock, whereas it had a weight of 0.54% in the index. In this period, Avenue Supermart's returns were 22.47%. The fund's higher allocation to Avenue Supermart worked in its favor as the stock generated good returns. Other stocks with a higher weight allocation also generated good returns during the period. The only stock in the top 10 holdings that did not work well was HDFC Bank. It has generated minus 4.81% return so far in 2024. However, Axis Blue Chip has a 9.23% allocation to this stock. In the index, HDFC Bank's weight is 11.31%, which means Axis has maintained a lower allocation to the stock. This worked in favor of the fund. Let's do the same exercise for DSP Top 100. So of the top 10 stocks, the fund had a higher allocation to 9 compared to the index. All 9 of them generated good returns on average. Even in this case, DSP Top 100 had a lower allocation to HDFC Bank than the index, which worked in its favor. So besides the higher small cap allocation, the weight allocation done by fund managers is the key driver to better returns by the active funds. Now let's see if you should invest in active large cap funds for your large cap exposure. Based on the data, two trends stand out. First, the active large cap funds have increased their small cap allocation. Second, the heavyweights in active large cap funds have generated higher returns, or what is also called alpha. However, these factors have some drawbacks as well. The higher small cap allocation can make large cap funds more volatile. It will impact returns if there is a market correction. Similarly, the active weight allocation can also backfire if heavyweight stocks of the fund do not deliver the expected returns. So far in 2024, HDFC Bank's underperformance has also impacted the performance of Nifty 100. This stock has the highest weight, which has resulted in lower returns by the index. If it was not the case, then many active funds that have outperformed the index would have had a similar or even a lower return than Nifty 100. So if you want to invest in large cap stocks, Nifty 50 or Nifty 100 index funds could be a better option. Here you'll have a lower expense ratio and no risk of getting stuck with an underperforming fund. Further, you can also explore other active categories like flexi caps or aggressive hybrid for your large cap allocation. Many funds in these categories invest predominantly in large caps. They also have generated better returns than the large cap indices. We have analyzed both these options in our earlier videos. I strongly recommend you to check them out. I've added the link in the description. With this, we have come to an end of this video. I hope you found it insightful. If you did, then don't forget to like this video and do subscribe to our channel so you don't miss any important video from us. I'll see you next time.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.